My name is Maureen. I'm the Marketing and PR Manager for the MEP Center here at the University of Utah, and I also oversee our Wednesday webinar series. And today our webinar is on tax credits for manufacturers. If we go to the next slide, I will introduce our presenter. Shawn? Okay, thank you. Just want to make sure you're there. So our presenter today is Shawn Marchant. He has 20 years of experience in identifying and quantifying R&D and manufacturing incentives for companies in over 20 industries. His experience includes initial project scoping through implementation, project management, IRS and state audit support, and evaluation of benefits for financial statement presentation. Shawn has also spent 16 years in the Big Four, most recently with Ernst & Young, where he led their research, credit, and meals and entertainment practices in the Southeast region. He is also a frequent speaker on the research credit and the 199 domestic production activities deduction. He received a JD from BYU, J. Reuben Clark Law School, and an LLM in taxation from Georgetown University. And he's also a licensed attorney in California. And before I turn it over to Shawn, if you have questions throughout the presentation, please type them in the chat box. And then, as I mentioned earlier, the presentation is being recorded, and the recording will be posted on our YouTube channel and on our website, and the slides will also be available for your use. So without further ado, Shawn, it's all yours.
Thank you, Maureen. Delighted to be here with everyone this morning. Or this afternoon, if you're, yes, we have to include, it's now 12:01, so it's no longer this morning. Delighted that we can speak about R&D credits and other manufacturing incentives available to manufacturers. As Maureen said, I've got a lot of years of doing this, been on my own with my own boutique for a couple of years now, and really help small to medium-sized businesses with these incentives. One of the things that differentiates us from others, we use engineers. So if you've got software or you're developing something, we've got mechanical engineers, electrical engineers that we leverage and use to talk to your people. And that results in a less business disruption, a more efficient process, and a higher quality product. And our real focus is on sustaining the amount of credits and deductions that you get, not just putting a number on the return, but really what's the cash in your pocket in the event that these claims do get audited. Here's our agenda for today. I'm going to talk about the R&D credit. This is the biggest one that affects manufacturers. And so I'll go through some of how you qualify, what expenses are eligible, and the mechanics of how the credit works. There's also, if you're a small business that is a startup, you haven't been making money, there's the opportunity to use these credits to offset your payroll taxes. And that's an exciting thing that has really made the credits much more valuable to the startup community. Heretofore, if you didn't have income and you were running losses, these credits, their income tax credits, they would do you no good. So there's been a change in the law in the last couple of years that makes companies able to use these credits. Next, we'll give you a legislative update. What's happened? Tax reform has been a big topic. A month ago, it's still in the news, though a little less so today. But what's the impact here on my tax bill? Did these incentives get affected at all? Next, we'll talk through how do I identify opportunities? What's out there? We've got a couple of case studies that show you the potential benefit that is available to companies that can claim these credits. And lastly, there's some contact information. So if you want more information, you can reach out to Maureen or myself, and we can help walk you through some of this, answer specific questions. And as you have questions, there will be natural breaks in here. Because of the way the screen's set up, I can't see if somebody has a question. So Maureen, feel free to interrupt me and ask a question, or there's a couple natural breaks in between each of the sections that we can talk through and talk through the questions. All right, so it's football season. We just finished college football, and so my pick six are these 6 key takeaways right here. And some people put them at the end. I like to put them at the front because this is really the gist of what we're going to talk about. If you remember nothing else, you should remember my phone number or my email address. But 2, the R&D credits, there's a lot of industries that can qualify for an R&D credit. I've been exchanging emails with a law firm of all people. They have developed some Bitcoin software, cryptocurrency software and so I'm talking to them about an R&D credit. You wouldn't think law firm, they'd never claim a credit. So there's a wide variety, and I've got a list of industries that I personally helped with R&D credits. Startups and pre-profit companies, you can monetize these R&D credits against your payroll taxes. In addition to the federal credit, many states, up to 41 states actually, offer a credit or an incentive for R&D activity. Most are piggyback off of the federal rules. So that makes life easier. What's the cash benefit in my pocket after the end of the day? You combine the federal and state. You're looking somewhere in the neighborhood of 10 to 20% of the eligible expenses. You'll get a cash in your pocket tax savings. Now, this is all nice, but one of the key things around the R&D credit I tell my clients is you've got to document how you qualify. It's not enough just to put numbers on a tax return and take a draw from the P&L and put them on a return and do the calculation. The R&D credit has a documentation aspect that is critical to sustaining these credits on exam. And we'll talk a little bit more about that. And then finally, we offer complimentary assessments. So what's the potential benefit? You say, Shawn, what's the potential benefit here? And how much is it going to cost me? Well, it's a function of let's see what your benefit is. Let's identify where the opportunities are. Where are the traps and the pitfalls that we could fall into? How much documentation needs to be done? After that complimentary assessment, then we can come back to you with a potential benefit and what a fee proposal ought to be. And anybody who you engage to do that, whether it's us or somebody else, they should really follow this process. Don't ever go with somebody that's going to quote you a fee without really looking at what the benefit is and the issues associated with that. All right, so let's dive into the R&D credit. And I'll say at the outfront, we may have more material here. In fact, we likely have more material than we can cover in an hour. So I may skip over some of this, but I leave it in here, and I could send you the slides later if you wanted. But it's kind of more background educational information. So the R&D credit's been around for a long time. Many of you may have heard of it. It's been around since 1981, and effectively it's a jobs credit. Congress enacted it to spur the creation of high-paying engineering and scientific jobs in the U.S. They did that in the early 80s. It's a 2-step analysis. One, qualitative. Do I qualify? Does my company perform the activity that meets the test Congress has said you need to meet in order to be eligible? Once I identify that I've got qualifying activity, then I need to cost account for it. That's step 2, the quantitative aspect. Adding up the dollars associated with the eligible activity, adding up the cost, and then going through the formula to compute the credit. I mentioned earlier documentation. I'll talk about this several times. Documentation is key to sustaining the R&D credit. And in fact, it's the number one reason you get disallowed. If you look at the tax court cases that are out there, the number one reason they get disallowed is number one reason is because they don't have the adequate documentation in place to support the credits they've claimed. And then lastly, I mentioned this before, 41 states offer an R&D credit, and they piggyback off the federal rules with some variation. All right, so what qualifies? We refer to it as a 4-part test. You meet these 4 tests, you don't fall into any of the exceptions, none of those exceptions apply, and generally you're going to be eligible for a credit. The first test is, are you improving or are you developing or improving a business product or business component? A business component is widely defined as a product, a process, technique, invention. It includes software, anything that you're going to use in your business or sell to a third party or enable a third party to use. So think of your natural product lines. That's generally going to be a business component. Next is your activities technological in nature. Essentially, are you using software? Are you using computer science? Are you using engineering? Are you using physics, chemistry, biology, the hard sciences? When the reason this is in there, when Congress initially passed this law, you had a bunch of social scientists, economists, lawyers claiming a credit, and Congress said, that's not what we want to incentivize. We want to incentivize development of real product and software. So we're going to limit it to this specific technology. The third and fourth tests, they are the ones the IRS focuses on, and your states will focus on. Is there technological uncertainty in order that you have to overcome to bring your product to market? You can have one of three kinds. There is the capability. Can we build it? No, I can't build it. I'm not sure that I can build this. That's a fine and acceptable technological uncertainty. How can we build it? Well, I'm sure I can build it, but I've got two different development paths I can go down, and I don't know which one will enable me to develop a product and achieve something I can sell to the market. That's also acceptable. The third one, and this is the most common, is what is the appropriate design? What are my design characteristics? What are the functional specifications or the technical specifications that I need to put together in order for this product to be able to meet its goal and us being able to sell it? I've got a company that's a medical device manufacturer. They're developing it's in the oncology field, and their technology has to be approved by the FDA. That is their current design. They're not sure it will receive FDA approval. They're sure they can build it, but they don't know whether FDA will approve it because they don't know it will meet within the design specifications that have been set forth. That's an okay example. But it doesn't have to be subject to FDA approval. There's not. I want to put that out there that none of this. The credit is not contingent on approval or authorization by some government authority that it meets the technical specifications. That's not a requirement. And the fourth and last one is, are you following some systematic process of testing, design, build, test, evaluate, redesign? We call that a process of experimentation. And you can do it through trial and error, computer simulation, building and testing prototypes or pilot models. You meet all four of those. You're building a new or improved product. You're using engineering or computer science to do it. It's technical uncertainty. We're uncertain as to the design, and we've got to go build a bunch of prototypes and evaluate those prototypes. You're doing R&D. Now the question is, do any of the exceptions apply? Well, those exceptions are listed here. There's 9 of them. Is it related to style, taste, or cosmetic or seasonal design factors? Think here of taste. Like I don't like strawberry M&Ms, right? I tasted them; they're not that great. That's a personal preference for me. Somebody else might really like them. So that type of research does not qualify. But the question becomes, well, M&M, we are trying to make a strawberry M&M that tastes like strawberry. It doesn't taste like blueberry or blackberry or raspberry. Trying to match that flavor profile, the research that goes into that would qualify. Next one, research after commercial production. Usually when you have a product that now you're releasing to the market, research has stopped. However, now you're going to come out with a new and improved version. You're going to make it faster, stronger, and lighter. Software might be more robust, might be able to scale it better. All that now all that R&D activity to enable the improvements to occur that would be eligible. Duplicating, adapting existing business components, this is one-off customization, excuse me, one-off customizations to customers that doesn't end up being made broadly available through the product base. Number 4, this is really reverse engineering. You look at plans, you buy a DVD player and you break it apart to see how it's built. That would not qualify. However, once you have that knowledge, now you're going to go build something that's functionally different, functionally better. That the activity to make something different would qualify. Survey studies, these really get into the market research. Who's your target market? Quality control. I'm picking a bunch of products out of the manufacturer lot and I'm testing them to make sure they meet the build. That would not qualify. Your efficiency and management studies don't qualify. Internal use, I'll talk about that in a second. That generally does not qualify, but there were some favorable regulations issued in 2014 that changed that, made it very favorable for taxpayers. The one I run into most commonly, foreign research. I conduct research outside the U.S. Maybe I hire a software guy from Eastern Bloc, and he does some development for me. The amount you pay to that person is not eligible. Or, I manufacture, but I have to fly. My manufacturer production people, they go to China every month for a week. The time they spend outside the U.S. doing R&D would not be eligible. That's the big one, and the IRS is very keen on that, particularly in the software realm, where so much is outsourced and it can be done. It can be and is done across the globe. Next, social sciences, research into the arts and humanities, that doesn't qualify. And the last one, this is the second most common, funded research. So you engage somebody else, or somebody engages you to perform research on their behalf. Now you need to do further analysis. Who owns the rights to the research and who's economically at risk? Same thing happens if you hire somebody to do work for you. Are you getting rights in that research and who's economically at risk? You have to look at the terms of the contract. And we could do a whole webinar, and I have done a whole webinar on funding and the ins and outs of funding. This is the most frequently litigated area, actually, within the R&D credit. It's funded research. So takeaway there is if you have a contract with somebody else, a non-employee, to do research on your behalf, the design and build of it, you call me or talk to your CPA firm, talk to somebody, because you need to do a funded research analysis. And I've seen this with a number of professional services firms, like engineering firms and construction firms. These are the ones that are really going to be subject to this here. And there have been some foot faults by taxpayers where they haven't analyzed that, and it's cost them some credits. All right, so I'll pause right there. Any questions, Maureen?
No, I don't see any.
Okay. Well, so let's say we qualify. What expenses can I pick up? There are 4. And you're limited just to these 4. There's the wages you pay to the individuals who do the work, who supervise the work, or who support the work. And it's the box 1 W-2 wage that you're paying to that person. So you have to strip out any 401k contributions they make, any health insurance that they purchase, dental, life insurance, anything like that the employee purchases with their pre-tax dollars. That gets stripped out. And then there's 3 categories of people. There's the people that perform R&D. There's those who supervise the R&D. That's first-line management. And those who support. Supporting functions really are, you get outside the non-R&D realm. And so you're looking at somebody in manufacturing or marketing or sales, technical support. Even the C-suite may sit in there in larger companies. And everybody may not spend all their time doing R&D, but they would spend some time evaluating products, talking about the design specifications, functional specifications, providing feedback. The amount of time they spend doing that, you would say that's related to R&D, and you would pick up pro rata portion of their wages. Now, there's a gimme in here. Congress or the IRS has said, listen, we realize even if you're working for Bell Labs, so much of your time may have to be spent in training, onboarding, company events, and the like. And so it's unrealistic that for somebody to spend every hour that they spend working doing R&D. So we'll give you a minimum threshold. If at least 80% of your time is spent doing qualified research or these performing, supporting, or supervising, then we'll let you pick up 100% of that individual's wages. So that's a nice little pickup. The other next cost that's eligible that tends to be a big one is supplies. These are the materials and components that go into building your prototypes. So let's say you're going to build a computer, and you would, well, in fact, a better example, you're going to build a fly. One of our audience members is a custom fly manufacturer. So you're going to have little pieces and parts. You're going to have the hook. You're going to have the thread. You're going to have some of the things that make up the fly itself, the little pieces, and you build prototypes. All the expense of those prototypes would be eligible.
Hey, Shawn, we have a question.
Yeah, go ahead.
So the question is, will the wages portion be different if it's an employee versus an equity holder in the company?
Good question. And that is an area that is actually getting some attention lately. It depends on the nature of the equity. If you're a C corporation, no, it's going to be whatever shows up on your box one. So just think of the general rule is box one, W-2, that's the wage you pick up. Now, if you're a C corp, you're not going to have anything else. If you're an S corp, you're not going to have anything else. If you're a partnership or an LLC electing to be treated as a partnership, then the conventional wisdom and accepted practice is that any guaranteed payments, distributions, and the like, they would be able to be picked up. So if you're a partnership, you can increase this more than just the W-2 box one income. That's a good question. The next one here is computer rental. So if you lease a computer, a lot of software companies are renting computer time now from Amazon Web Services, Microsoft Azure. Those rental payments for the portion that relates to hosting software under development is eligible for the R&D credit. And the last one, this tends to be the third biggest one or second biggest one, depending on your company, contract research. So amounts you pay to non-employees, and this would be total amounts. So if you hire a contractor to come in and do some development work for you, and the funding, and you meet the funding and rights issue, and that contractor, they may bill you their fee, they may have travel, hotel, airfare, meals, rental car in that. You can pick up that whole amount, and then you haircut it to 65%. And that 65% is specified by Congress. Collectively, these four expenses are known as qualified research expenses, or QREs. So when I use the short form QREs in the future, you'll know what I'm talking about. This here gives you just a quick idea of from ideation really through commercial production, what steps are eligible for credit and where you can pick up the associated expenses. Now, how do you compute the credit? We've identified and determined that we are eligible. We've cost accounted for it. What's my credit? How much is it going to? What am I going to get in my pocket? And here's the formula. It's pretty basic. You take your current year QREs right here. You subtract the base amount, and we'll talk a little bit about that in a second. That gives you your incremental QREs. You multiply that by your credit percentage, and that gives you your credit. Simple enough. Well, this base amount is what becomes fairly complicated and what the IRS will often look at as a source to try and disallow your credit. The base amount depends on which credit calculational method you use. There are two. There's the regular credit and the alternative simplified credit. The regular credit, it's your base amount is really a percentage of your historic sales. And that percentage is taxpayer specific. Depends on when you started. It depends on how much, and that will really depend on what years you pick up. So it's either that percentage or at a minimum, it's 50% of your current year qualified research expenses. And I've got an example, we'll walk through this here in a second. The regular credit is 20%. So it's more complex, harder to calculate, but you get a more lucrative credit. The simplified credit is easier to calculate, but the trade-off is you take a lesser credit. And a taxpayer can elect either one of these in a current year, but once you have elected that credit method, you can't go back and change your mind on an amended return. The simplified credit, your base is simply your 3 prior year QREs times 50%. So even if your R&D spend stays flat or decreases a little, you'll still get a credit under the simplified method. Your percentage is 14%. If you're startup, so let's say, Shawn, I started up this year or last year, 2017. I don't have 3 years. What do? You just take 6% of your total of your top line amount here. Credit research QREs. There is no base threshold. Section 280C, this is in Congress enacted to prevent double dipping. So at this point, you've deducted your salaries, your supplies, your contractor payments to reach your taxable income or to generate a loss. And now you're going to claim a credit on the same amount. Congress has said you can't do that. That's double dipping. So we're going to make you adjust the amount of credit. You take a lesser credit or you adjust your taxable income or your loss for the amount of the credit. It eliminates that double benefit. But what's the federal credit? The federal credit really ranges 6.5%, 10% of QRE. So if you want to just cut through all the calculational minutia and say, Shawn, I've got $1 million of expenses here. What's my credit? 65,000 to 100,000 of credit. That's a good rule of thumb on a federal level. State credits range is a much broader range, 1.5 to 10%. Utah's got a pretty good credit. So if you're doing Utah, if you're a taxpayer in Utah, you're making money, Utah's got a really good credit to use. When you combine it with the federal, you could end up 20% of eligible. I'm going to walk you quickly through the credit. This is a real client. This was for 2016. We determined they had $560,000 of wages. They had $40,000, $41,000 of supplies, no computer rental. Their contract research for the year was $55,000. That's at 65%. They add all that up. That's almost $660,000, $658,000. This fixed base percentage, again, that's taxpayer specific. We determined that through our study. And this is the 4 prior year gross receipts. So you take this fixed base percentage here, you multiply it by the trailing average 4-year gross receipts, and that gives you your base number. And that's 24,000. You compare that to 50% of your current year QRE. So this 329 is just 658 times 50%. And the greater of this one or this one is what your minimum base is. So I have seen this with taxpayers where this calculated base is actually greater than your credit. And in that case, you would not get a credit if it was in the case of 2 years before 2007. After 2007, that's where Congress enacted the alternative simplified credit. You just use the ASC. So here's our minimum base. We subtract this from our total QREs for the year. That gets us 329. Our tax rate, our credit rate is 20%. So this is our gross credit. We've got a gross credit of almost $66,000. But remember, we've double benefited for it. So we need to subtract back a certain amount of those expenses, that credit, and our net credit cash in our pocket, almost $43,000. Now, let me give you an example of how this would work under the same expenses would work under the alternative simplified credit. Again, we've got $658,000 of QREs in the current year. Here's our prior year. Now, you'll see that they had a real big increase in spend from 2015 to 2016. And you can, this is what you're going to see with startup companies or growing companies. They're going to have an increasing R&D spend. Well, the average of these 3 years is 247. You multiply that by 50%, that gives you 123,000. That's our base. You subtract that base from 658, gives you 535. Times 14% is 74,000. Well, our credit here was, our credit under the regular method was 65,000. So even though I had a higher percentage, I result in a lesser credit because my base is higher. So under this scenario, I'll go, I'll take the alternative simplified credit, almost $75,000. I add back the expenses, and here's my net cash in my pocket, $48,000. Again, versus $42,000. So that gives you a good overview of how the credit works. When you're looking to compute a credit in a current year, you should always be comparing the regular credit to the simplified credit and taking whichever one is greater for you. Now, what documentation? Let's talk a little bit about documentation. Qualitative. You have to demonstrate why the R&D activity you're performing, why and how it meets those 4 tests. You do that. And generally, companies don't have this kind of product, these kind of documents in hand. They just unless you're a Bell Labs or a pharma company or a medical device company who kind of has to generate this work for FDA purposes, and some energy companies might have to as well for regulatory purposes. You generally don't create it, and that's why people like myself can have a career doing R&D credit studies. Is we help companies generate this kind of documentation. Think of it as an insurance package. In the event you get audited, you've got some assistance or some support for what you put on a return. These are the kind of documents that are available. Memos you would generate, memos describing what they do. You would couple that with any reports that you would generate if you've got lab reports or design requirements, functional specifications, whiteboard agendas, or meeting agendas, product review meetings, those kind of things. Larger companies may have a formalized product development process with documentation, and that kind of documentation is very helpful too. Small companies generally don't have this kind of documentation, and so they need help creating it. That's on the qualitative side. On the quantitative side, you need to have the P&L detail, the wage detail. You need some support for why we're picking up 90% of a certain person's time and 40% of another and 20% of a third person. You need to be able to demonstrate that. Some companies employ project tracking. They have their people track time to projects or activities just like lawyers and accountants do. Most companies don't do that, but that's a very acceptable form of qualification or quantification of someone's time. Again, I mentioned P&L, wage return, tax returns, and sometimes you have to get into the transaction level detail for contractors or computer rental and supplies and the like. All right, I'll take a quick break. Anybody, any further questions?
No questions.
Okay. Let's talk payroll credit. If you're not making money, you're not paying tax, this is what may be of interest to you. So this, to claim the payroll credit, you have to meet 3 criteria, and I'm going to cover them not in the order listed. The first criteria is you have to claim an R&D credit. You have to be eligible for and claiming an R&D credit. So you have to perform perform activity that meet the 4 criteria, that none of the exceptions apply, and you cost account and you compute a credit and you put it on a return. That's the number 1 requirement. Number 2 is you, in the current year, the year you're looking to claim an R&D credit, you have to have less than $5 million of gross receipts. Now, gross receipts is a pretty broadly defined. It includes not just your top line sales, less returns and allowances, but it also includes rents, royalties, dividends, interest, capital gains, the like. So it's a pretty expansive definition. So that's easy enough to tell. Okay, I've got $3 million this current year. I meet that test. The next test is there's a look back period. You can have any amount of gross receipts in the 5 years up to and including the credit year. But in the 6th year before the credit year, you can't have any gross receipts. That means $1 of interest income will disqualify you. So how does that work? For 2017, you start counting at 2017 and count back. 2017, 16, 15, 14, 13. There's my 5-year window, 13 through 17. If I had gross receipts, $1 on my return, I'm ineligible for the payroll credit offset. Doesn't mean I can't claim an R&D credit. It means the R&D, if I'm in a loss, the R&D credit would just go in a carryover position and would stay as an asset on my tax balance sheet until I start paying income tax. It just means, so you would not be eligible for the payroll credit. Now, for 2018, you can't have gross receipts prior to 2014. This can get, and there was a company I was talking to thought they were eligible for the R&D credit or the payroll credit. It turns out they switched legal entity. They converted from an S corp, from an LLC to a C corp. That terminated a tax year. It split their tax year into 2 years, and it made them disqualify because it pushed their first year. They started in 2012. They thought they were eligible. They had revenue in 2012. In 2014, they changed legal entity. They had to file 2 returns for 2014. That pushed 2012 outside that 5-year window. It made them ineligible for the payroll credit. So there needs to be some thought given and analysis looked at when for qualification purposes. Who's eligible? Corporations, partnerships, sole proprietorships. If you're tax exempt, you're not eligible. And I've seen this question a bit. What if I use a PEO, professional employer organization? Am I eligible? The answer is yes. The IRS issued some specific guidance that countenances the ability for a company who uses a PEO to claim the payroll credit, and you would need to work that out with the PEO in terms of offset, how you would get compensated for it, because they would be the ones offsetting the payroll tax they're withholding on the employees. How do you use the credit? There are some mechanics to this. It's effectively there's some timing deadlines you need to be aware of, because there's an election you have to make on the return. For 2017, you're fine. 2016, if you said, Shawn, I want to claim it on my 2016 return, if you were a calendar year taxpayer, that ship has sailed. You can't go back and amend a return to claim it. It's only prospectively. So 2017, be mindful of this. But the way it works is you file your R&D credit, you make an election on that form that gets filed with your federal return. You effectively tell the government, the IRS, I'm going to elect to use some or all of my R&D credit to offset payroll taxes. And then there's a bridge form that goes with the 941, your payroll tax form, that then tells the IRS this is, syncs it back to the R&D credit form. That timing of that is you claim the R&D credit on your return. The 941 due the next calendar quarter is when you would start applying the R&D credit. So practically speaking, you file your return by 3/15 or 3/31 this year. April, you can start using the payroll credit to offset payroll tax, the R&D credit to offset payroll tax. And you continue to use it if you've got excess. Let's say you've got an R&D credit of $75,000, but your payroll taxes for the year are only $50,000, then that remaining $25,000 would carry over to the next year. So you continue to use it until you run out of it. There is a cap, $250,000 a year of payroll credit you can offset, and you can only claim it for up to 5 years. Any questions on payroll?
I don't think we have a question on payroll, but there was a question from the previous section. So it says, travel within the U.S. to go find a new manufacturer, would that be eligible? I know you said travel to China to check in would not, but travel within the U.S. to find and identify a manufacturer outside of the U.S. Would that qualify?
If the product is already developed, no, it would not. If you're trying to find a manufacturer who can build your prototypes for you, I think you've got an argument. I would include it. But if it's already an existing product and I'm looking to find a vendor who can manufacture it for me, that would not qualify, based on the facts I've been told. All right, legislative update. Big news last month. I don't know if you've seen the personal impact on your personal returns yet. Hopefully you will. Hopefully it will be favorable. From an R&D credit standpoint, there wasn't any change. There was no change at all. Didn't change the mechanics, didn't change the rate, didn't change how you qualify, did not change the ability to claim the payroll credit. It's all there. There was a change that impacts companies' ability to expense their R&D. Up to this point, you've had a choice. You can expense your R&D for tax purposes, or you can capitalize it and then amortize it over 60 months. Congress said, yeah, we're going to stop, and then we will eliminate the ability to expense R&D. You now have to capitalize it and amortize it over 5 years. This has been suspended, though. It does not. The delayed effective date is not until 2022. If your R&D is offshore, it wouldn't be eligible for an R&D credit, but you may still claim it. Let's say I've got some companies who hire software developers in the Eastern Bloc, and they pay it out of the U.S. Well, that R&D activity would need to be amortized over 15 years, starting in 2022. It does include software development, but there are some ways we could plan around that. So we can give you some advice, or your CPA could give you some advice as to how to plan that, because your wages, you don't necessarily think your wages as being an R&D. Your wages are wages, and you're going to expense them under compensation on your return. So there are some ways to get around that. The other one that we haven't talked about, and we can talk about a little bit later, is the domestic production activity deduction. This is a 9% deduction that taxpayers could make on their return for products that were manufactured in the U.S. It was effectively an incentive to manufacture goods in the U.S. With the lowering of the corporate tax rate and lowering of rates overall, they said, listen, we'll do away with this. We don't need the incentive anymore. And so starting 2018, this is no longer available. If, however, you are manufacturing things in the U.S. and you haven't claimed it, we can talk you through that, because you can claim it on your 2017 return, or you can go back and amend returns for all open years. A couple other highlights here. Your corporate rates dropped from 35 to 21%, and then your individual rates also reduced. So if you're a flow-through, you should see a reduction in your rates. But they did tighten the bands to which these percentages will apply. Again, hopefully everybody will recognize a reduction in their taxes in 2018. And you should start seeing it immediately, actually. Withholding taxes should be adjusted. Payroll companies have been scrambling to get these things adjusted for the first payrolls that will be coming out this year. Utah reform. There has been a lot of talk around Utah tax reform, broadening the base, lowering the rate. What are we going to do with sales tax? How are we going to pay for education? The Senator Howard Stevenson, has really been an advocate for effective tax incentives. Let's make sure let's incentivize business, but let's do it the right way. And I saw a draft of a bill circulated that would eliminate the R&D credit and eliminate or make it much more difficult to qualify for. And so keep your eye open on that. If you've got any, contact your legislature, find out where things are from a Utah tax reform. Stay tuned is what I would effectively say. There's not a lot of updates. There's nothing been introduced in the legislature right now. There was a couple bills introduced in committee. I think they're still in committee and don't have enough votes to get out. But keep in mind that the Utah legislature really wants to tackle tax reform this year, their own version, and that could impact the R&D as well as other credits and incentives and sales and use tax. All right, another break. Any other questions?
I don't see any.
Okay. So what are my opportunities here? Well, these are the industries that I've personally claimed R&D credits in, and these tend to be the departments. So some of these you look at, and you think, well, that's a no-brainer. Aerospace and defense, agriculture, that may not be one that immediately comes to mind. Food and beverage manufacturing, all kinds of manufacturing. This is to MEPS. We're talking to manufacturers. If you are developing a product and you're manufacturing it, I don't care where you're manufacturing it. It could be here, China, India, Philippines, Vietnam, doesn't matter. If you are doing the development work in the U.S., you should be claiming an R&D credit, right? Apple's tagline, designed by Apple in Cupertino, manufactured and built in China. Guarantee you, Apple is getting an R&D credit for every dime they spend developing the iPhone 8, iPhone X in the U.S. Departments, R&D engineering, that's really the low-hanging fruit. Manufacturing engineering, how are we going to, if we manufacture it in the U.S., or if you're even manufacturing it in China, but you're doing some of the thought behind and the design behind the manufacturing process in the U.S., that would potentially be eligible. Quality assurance is eligible. Now, I would differentiate quality assurance from quality control. Quality assurance is during the R&D process. You're validating the product or the prototype is meeting design specifications. Quality control, you're picking lots out of the manufacturing and making sure they meet the manufacturing specs. That's the distinction. You can include marketing, technical sales, services, environmental health, safety, regulatory affairs, and then executive management. You just need to make sure that everybody outside the R&D and engineering function you're documenting that activity. Especially here in the CEO, president, senior management area, that's where they tend to spend more time auditing. Scoping questions. If you're wondering, well, am I going to qualify? What do I need? What are some of the threshold questions? Are you employing engineers, scientists, computer programmers? Are you developing or improving products? Have you improved your manufacturing process? And then you have a separate R&D or budgetary item. Now, let's talk about some actual client successes. All of these are device manufacturers. Well, there's one a software company. So the one here on the left is a software company. But consumer products, $67 million of revenue. Their R&D spend was $1.4 million. Did a one-year study for them. Their federal and state credits, and this is a flow through. This is in the C corp. $210,000 that flowed right to the S corp members' pockets. Their domestic production activity deduction, $460,000. So that was more lucrative to them than the federal and state credits. Medical device manufacturer, this again, another company. Now, this one's not making money yet. And so they only had sales of $2.6 million. This was their R&D spend. I talked to them about a pay. They'd never even heard of a payroll credit. Their CPA introduced me. Went in and talked to them, got them federal and state credits of $180,000, of which payroll credit was $82,000. And that was real money on a, and they've gotten that fully refunded now. So they're very happy with the benefit they've received. Here, this is a really small company. They only had sales of $20,000, $19,000 last year. Their R&D spend was basically 1.5 people doing work. We did a 1-year analysis for them. They got a payroll credit of $8,500. And so there was and that's a benefit to them. And they're adding headcount this year. They would continue to see growth, and so this number will increase over the years for them. Software, I throw this one here as a software just as a reminder that a lot of times you might be manufacturing something, but if you're developing software, if you've got a hardware software component, don't forget the software aspect of it. This is an S Corp. You can see it's a mid-30s, $30 million company. Their R&D spends $500,000 to $900,000. Did a 3-year study. Their credit, federal and states, $414,000. Again, this is a flow through. So this is just to show that, depending on, it doesn't matter whether you're a C Corp or an S Corp. You could have been a partnership. It could be an LLC. Doesn't matter if you're spending millions of dollars on R&D, or if you're only spending, $100,000 or less. There's some benefit to you for this. Now, here's the other incentives that are out there. I mentioned briefly the domestic production activity deduction. This one is going away 2018. It's a 9% deduction. The short way, the best way to calculate it, the short way is to take a look at your taxable income on your return, times it by 9%. That's your deduction. That'll give you an idea. You need to do some more work to really validate that, but to decide if it's worth pursuing, that would be it. Again, you can amend returns. The work opportunity tax credit. This is a hiring credit. If you hire an employee that falls into one of 9 categories, then you can get a credit for them ranging from $1,200 to $9,600 per employee. The categories, and I won't get them all, but the big ones are food stamp recipients, veterans, disabled, Social Security recipients. Those tend to be the big 4. Again, food stamp recipient, veteran, disabled, Social Security recipient. Oh, short-term and long-term unemployed. Those are the other 2 categories that we get people from. This is an application process. There's some deadlines associated with it that you have to meet. The screening and determination has to be done before the person starts, during the hiring process. Once the person has started, you can't go back. So this is one you really have to be on top of. This one doesn't depend on the industry. Where I see a lot of it is manufacturers who have an employee base that tends to be an hourly wage base, retailers, food and beverage, restaurants, those kind of individuals, those kind of taxpayers. All right, there's some state incentives out there. As we wind down here, there's a Utah credit. If you've been around for a while and you've got losses, and again, around for a while, I mean, we're talking 2010, then you can get a credit for your purchases of R&D machinery and equipment. This did expire in 2010, so if everybody on here has started since 2010, this wouldn't really apply. But if you started back then, you're in losses, you could go back and amend a return. Another incentive for manufacturers, if you're using recycled materials in your process, or you collect or process or distribute recycled materials, there is a credit available. This credit is available through GoEd. Credits 5% on machinery and equipment, and 20% with a limit up on eligible operating expenses. And there's some links to more information on this one. The other incentives are out there for manufacturers: sales and use tax exemption. So manufacturing equipment, R&D equipment, non-returnable containers. So you package something in a container that somebody can't give back to you. That is those containers you get a sales and use tax exemption on. If you use semiconductor, this is really called the Novell exception. When they were trying to get Novell to build their facility there, Point of the Mountain, Thanksgiving Point, they threw this in there. So if you're using silicone semiconductors in your manufactured goods, you can get a sales and use tax exemption. It's not specific and exclusive to Novell. It's just that's when it got put in, was in incentive Novell. And then lastly, if you're developing an R&D facility, then you can get a sales and use tax for the materials that go into building that facility. Those would be the extent of the exemptions. Any questions at this point?
I don't see any questions, and we have about 5 minutes left.
Yep. And we will finish on time, if not a little bit before. So I want to just give you a little bit of background about our approach. Again, I mentioned audit drives deliverables. We do the complementary assessment. That's really phase one. Kick the tires. Try to do it without an undue burden. We need a little bit of information: wages, P&L, tax returns. Then we usually have a 1-hour call with somebody from the engineering or development front to talk through what was done and who was doing it and how much were they doing it. And from there, we can come back to you with a guesstimate as to what we think the benefit would be and a work plan to document it and a fee. And then phase two is really refining the credits to put on a return and documenting those credits to support the return filing. And that's it. That's the end of the presentation. Here is how you can get a hold of me. I'm at Shawn@SMARTAX.pro, and there's my phone number from my days in the LA area working with Deloitte when I started my career. And then here's how you can get a hold of Maureen and the professionals there at MEP. Email or call. And with that, I'll ask one more time if anybody has any questions.
So far, I don't see any, but if anyone does have questions, please feel free to email or call Shawn.